Hello everyone, welcome to our discussion of Chapter 5 and itemized deductions. So remember, the concept of itemized deductions is these are what you might consider personal costs. These are that are deductible after AGI, so from AGI, but only if the total of these itemized deductions is greater than our standard deduction. So remember, it is always the highest of either the standard deduction or itemized deductions. And you always want to think about that when you're working on a tax return or looking at a tax situation. The whole discussion of deductibility of itemized deductions may be a moot point if the standard deduction, with any extra standard deductions that we learned about back in Chapter 2, is higher. So sometimes you'll spend a whole lot of time researching or trying to figure out if something in particular is deductible when it won't matter, because it's even with it won't be over the standard deduction. So you need to look at that first before you say, okay, trying to gather up receipts and all of the things that you might need to justify an itemized deduction. So there's really narrowed what is deductible as an itemized deduction down considerably over the last couple of years. So there really is just 3 or 4 categories that things fall into now. All right, so it actually is simpler. As well as the fact that standard deduction was increased dramatically, and therefore fewer people are going to benefit from itemized deductions. So the first one, in order that it goes on the Schedule A, and all of these are reported on the Schedule A. Remember, we talked about Schedule 1 through 6 supporting the 1040. This is Schedule A. This existed prior to the change in the 1040. We're looking at medical expenses. So now, when you're looking at itemized deductions, remember the total has to be more than the standard, but each individual itemized deduction category may have limitations, and medical expenses is one of those. Meaning, medical expenses are not deductible at all. They don't get counted as an itemized deduction until they reach more than 7.5 of your AGI. So if you have 100,000 of AGI, then if you spend your medical expenses are 6,000, they don't do you any good. If they're 7,000, they don't do you any good. They don't start becoming deductible until they're over 7.5, which would be $7,500 if your AGI is 100,000. And then only the amount over that 7,500 would be deductible. So they have to be over, and then only the amount over that is deductible. So it's very limited. It's really only going to apply in situations where there is a lot of illness that is not covered by insurance. Okay? So notice that there are some other limitations. It can only be medical expenses for themselves, the spouse, and dependents. You pay your friend's medical expenses, and technically that doesn't count. All right? And it can't be reimbursed by insurance. So you're not going to deduct something that the insurance companies would pay. Even if you pay it to the doctor, if you later are going to get reimbursed by the insurance, then that is not a deductible medical expense. Now, you can deduct it in 1 year and then get reimbursed in the next year, but guess what? That's going to be income to you when you get reimbursed. Normally, when health insurance pays you, as we learned about back in Chapter 3, that is not income to you, but if you got a benefit for deducting it, then it would be. So that's kind of hard to keep track of as well. So generally, if it's going to have anything to do with insurance, you're not going to deduct it. So what is the key to being a medical expense? Most of the time, the standard is it has to be doctor prescribed. There has to be for the treatment that of a particular illness or alleviation of a particular condition. Things that are for your general health, like vitamins or exercise or things like that, are not deductible. Now, they expanded some things. For a while there was controversy over whether or not, if you were trying to stop smoking, if that was a specific or a general. And it started out kind of, the IRS said it was general, and kind of with some pressure they backed off that. And so smoking cessation programs typically are considered medical expenses. Generally, if you can buy the stuff over the counter, it's not deductible. If you have to have a prescription, it is. There, of course, will be controversies over things like medical marijuana. Generally, the definition has been pretty broad, meaning the IRS has not disallowed things that are maybe non-traditional, as long as a practitioner or professional prescribed it. For instance, acupuncture and acupressure. Some folks, some places believe that's not legitimate health care, but others do, and they have accepted that and things. But it has to be alleviate a particular condition. So what will happen with medical marijuana, especially with the change in the administration, much more friendly to that idea, chances are going forward that will be considered a medical expense, even though on the law, federal law, currently it is illegal. But typically it's pretty clear what's a medical expense, and it's everything, dental, eyeglasses, all that stuff is part of that, because that's alleviation of a particular term. Cosmetics is not going to be. If you get plastic surgery to repair an injury, that's one thing. If you get plastic surgery because you want to get a modeling job, or because your nose is too big, then that's probably not going to qualify. Now, there have been those who have claimed that as a business expense because they needed it for their business, but that's a different category, not as a medical expense. And it has to be paid during the year, okay? We're really looking at when the cash was paid, not when actual care, because sometimes there's a delay. Now, the other issue that comes up with medical expenses, and taxpayers have won cases as they've gone to court over things such as the famous one is a hot tub. Now, if you can prove that you had a condition and a doctor prescribed you getting a hot tub in order to provide therapy for that condition, then you technically could deduct that. Now, what the IRS comes in after that is they say, okay, you spent $7,000 on the hot tub, but $5,000 of that increased the value of your house. So you got another benefit from that, not just the hot tub. And so the only deduction you can have is the $2,000 that you basically spent and didn't get any benefit from. And that is going to hold up in court. So you would have to prove that the amount it increased your value is less than the $5,000 or something like that to get a bigger deduction. So that's where the capital expenditure issue comes in. Transportation costs going to and from, 17 cents a mile, as well as cab, bus, train fares, $50 a night for stays while receiving care if you need to be there, like say first thing in the morning, or it is at a place where you need to travel overnight. And that can be for a family member. So for instance, if mom has to take the daughter over to the hospital, stays in a hotel while the daughter's in the hospital overnight for some type of treatment, that hotel night would count, but maximum of $50, which isn't much, but it's still something. Okay, premiums for long-term care insurance and all health insurance will generally be a deductible medical expenses if they're not already taken out of your income. So if your employer pays your health insurance premiums or helps pay them, that part is you have it taken out of your check, that part is usually already taken out of your wages. And so that would, you can't then deduct it here again. That would be double dipping. So premiums that you pay directly, and remember the HSA issue back in chapter 3 as well, which would be coordinated with this, because you would have the care for the actual premium on the high deductible insurance, and you'd have your contributions to your HSA, and they're treated differently. The contributions to the HSA would be back in chapter 4, and the medical expense for your actual insurance would be here in chapter 5, itemized deduction. Okay, next category, state and local taxes. All right, so the big ones here are property taxes, and state and local income taxes are typically the big ones, although there's also the possibility of state sales tax. All right, there's also personal property taxes if they're paid on the value of personal property, which is somewhat unusual. For instance, in some states, the amount you pay for registering your car is based on its value. That would be a personal property tax. In Pennsylvania, you pay the same fee regardless of whether you're driving an old beat up car or a brand new one. So that's not a deductible personal property tax. The overall reduction limit. So this income tax, this state and local taxes, all of them, the real estate taxes, the income taxes, all of them together, cannot be deductible if any more than $10,000. So it's just the opposite. Where medical expense. Medical expenses are deductible once they reach a certain amount. These stop being deductible when they reach a certain amount. You're actually penalizing those who pay a lot of state and local taxes. Okay, they're anything over the $10,000. For everybody, you notice the only one that has that reduced is married filings separately. Another penalty for married filing separately. So, real estate are deductible for all of any property. Real estate taxes are probably it doesn't matter if it's on your house in the mountains or on the beach or in another country or in another state. That real estate taxes based on value. Okay, what you have to be careful of are things that might be considered what we call special assessments. So, for instance, the municipality or city has a special tax which is just to pay for fire hydrants or for new lighting. If that's that specific, that's not considered deductible. That's considered additional value to your property. And so you have to watch for that, because sometimes they'll break that out rather than paying for it out of the general fund, which is where all your other taxes go. And if that's the case, you may have some piece of what you pay is non-deductible. Okay? There's our stuff about personal property taxes, cars, boats, motorhomes, that sort of thing are usually the items that you see a personal property tax, not on things like your couch or computer or things like that. No one's that I've seen, no municipality has tried to do that, at least not for personal. Some do that for business, but not for personal. So how do you know how much they pay? This is what you have to be careful. You're looking for the state and local taxes. In Pennsylvania, we have the local income tax that is withheld out of their check. You're looking for what they pay if they pay more when they send in their return. And sometimes they're going to pay estimated payments. They're going to pay a little bit if they have a business or something. And you have to look at those payments and decide which ones are paid in the year you're looking at. So if we're doing a 2020 return, we're looking at all the taxes paid for state and local things during 2020. Even if we paid it during 2020 and it was for 2019, because there's always that delay, that doesn't matter. It's when you pay it, not when it was assessed. Okay. Now, we've already talked about state refunds, right? If you have a tax benefit, deducted meaning you itemize those state and local taxes in the past year, and that may give you a tax benefit, and you get a refund this year in 2021, that refund could be taxable in 2021 because you're getting back something you took a deduction for the year before. Now, one caveat, there is a provisional law. If you're in a state that has a low income tax or zero income tax, then you can deduct the state sales tax. So it's either the state income tax, state and local income tax, or the state sales tax, one or the other. It's not both. So you're going to have to try to look at your state sales tax and see if it's worth taking that, if it's more. All right. Now, sales tax is a much harder thing to track because people are not withholding it. It's charged on every one of your purchases. So you could keep all your receipts for the year, for all the receipts you buy and all the sales tax. That's ridiculous. So nobody wants to do that. So what the IRS did with this provision is they produced a table which is based on your income and state you live in and that sort of thing, and it tells you this is how much we estimate you'll pay in sales tax over the course of the year, and that's what you can take as a deduction. You can add to that amount any big items, like you pay sales tax when you buy a car or some other large ticket item like that. That would be in addition to the estimate that you provided. And there's a website that provided an estimate. There's a chart in the instructions to the reform. Either one, okay? So generally, in Pennsylvania, your income tax is still going to be higher because we don't pay sales tax on food or clothing, which means that the amount we pay in sales tax is generally on the lower side unless you had a really big purchase during the year. Then it might be higher. Foreign taxes don't come up very often and is usually not the best thing to take a deduction. You're better off usually taking a credit for taxes you paid, meaning you get to reduce directly, dollar for dollar, the taxes you pay on your U.S. tax return by the taxes you paid on income from somewhere else. Typically, this is involved in an investment that, say you bought stock in a German company. That German company pays you dividends. They may withhold German income taxes. That you should not have to pay U.S. income tax on that in addition to German income tax. So you get a credit, which is usually better than deducting it here as a deductible state and local taxes.